Well, hello everyone. It's 12:30 according to my computer and phone and everything here. So, um, wanted to welcome y'all back for if you took some time off for the holiday weekend. Welcome back. It was beautiful weather-wise, at least for the weekend. So, uh, everybody can hear me? Yeah.
Yeah.
So we're getting pretty good at this. And so things are working fairly smooth. We've got recording going so that we can make that available. Um, any questions or problems with accessing, for instance, those recordings from past? Anybody had any trouble? I mean, I know they're long and you probably want to just fast forward through some of it because but just want to make sure everybody's able to see that wants to, at least. All right. So again, if you have a concern or question about that, just put it in the chat or the discussion board once we're if you think of it after class, after we're done today. So this week we're talking about financial statements in detail. But before we go to those formulas, if you will, we have started on the second memo having to do with explaining the principles of accounting. So I have seen several of them turned in already, but that is due this evening. All right, if you haven't gotten that in already. When I give you a 10 on that, that is just to tell you that you met the minimum requirements. So when you do your exchange with someone else, please feel free to continue to improve on what you turned in, okay? Based on your feedback back and forth with one of your colleagues. It does not mean that it's perfect and beyond reproach. I hope that that's not the message. We always want to continue to improve. What I was looking for when I went through it this time is just, again, did it meet the minimum, one page? Did it address the topic? Was it in that memo format sort of thing? But not that it was, that didn't need some improvements. It's just that those suggestions for improvement are hopefully going to come from your colleagues, not from me, like they were on the first memo. So that's what we're working on right now, as well as we'll have a discussion again this week about how the financial statements work together, that we'll talk a little bit more about on Thursday in preparation for doing that. We are approaching, I know it seems very quick, but we only have a short time together, the midterm exam, and that will be available later this week. And you'll have until into the next week to complete that. So that will be a Dropbox, and it will entail a couple of problems that I will provide you in the Dropbox. So I see in the chat that you're partnering up for the memo, so please feel free to do that. That's a great way to do so, to do that while we're here together. I think those are the things that I wanted to make sure I reminded you of as far as coming up. Any other questions about materials, reading, anything else that we have done so far? All right, so I'm going to share. Go ahead, Brandon. Brandon, if you're talking, I cannot understand what you're saying.
I was just going to verify that memo is the principal memo, right?
I cannot understand. Ooh, I'm still getting a lot of echo. Could you put your question in the chat, maybe? I don't want to not answer it, but I'm not getting it from your. Yes, yes. Memo 2 is the accounting principle. So memo 1 was the careers. Memo 2 was the accounting principle explanation. And in that memo, that second memo, you need to pick one. A couple of them have kind of tried to talk about accounting principles in general, and that's a little hard to do in a page. Okay, so you pick one and talk about that. It'll be much easier and actually better writing because you'll have to focus more. So, all right. So we got that question answered. Let's go to our PowerPoints. I'm going to share my screen. Okay, so going right into financial statements. So I'm going to go over them in the order that I think you should do them whenever you are asked in real life or in a test or homework or anything else. Doing financial statements, you should do them in this order. Income statement should be first. All right. And we'll see why here in a minute, but that should be your first financial statement. So two terms you might come across: income statement, statement of operations, and we even saw that Starbucks used the term statement of earnings. Okay, so all three of those are used interchangeably. You will find that income statement is the most common in textbooks. But in real life, many firms have gone to one of the other ones, just I don't know, just to be different or to be sounds more sophisticated or whatever. But that is the three terminologies. So we start an income statement with revenue. So you always have revenue at the top of the income statement. It should be the first thing we come to. If you're going to break it down into different types of revenue, say you sell stuff like inventory, and then you also provide services, and you want to put sales of stuff separate from sales of services, that's fine, but those should be at the top, all right, of the income statement, the first thing that comes to. So it's kind of telling you how important it is. It really is the starting point. If you can't create revenues, it doesn't really matter what the rest of your business is like. It's not going to work. Now, the next step is we're going to subtract. That's what we mean by less. Subtract cost of goods sold. That is our first expense. So make a little note somewhere in your brain, on your hand, in your note somewhere. Cost of goods sold is an expense. It's perhaps the most important expense and often the very biggest expense for a company. And the definition of cost of goods sold is what it cost us to make or buy or whatever the stuff we sell for revenue. So if we were to use Nike as an example, cost of goods sold was what they cost to build or make their shoes or buy their shoes from the manufacturer, ship them to the United States, okay, or to wherever they need to get sold, and then put on the store. That cost of getting those shoes or their sweatshirts or whatever they're selling, made, purchased, brought to wherever they need to be sold and put on the shelf, that cost, when that item is sold as revenue, it becomes a cost of goods sold. While it's still sitting on the shelf, it's inventory, it's an asset. But at the point that it gets sold, it moves from the asset to cost of goods sold. And if you're thinking about Nike, that's happening millions of times a month, right? Across the world, as various items are moving from inventory, future benefit for an asset, to cost of goods sold, an expense, the cost of earning our revenues. Because if you don't have those shoes, you don't have those hoodies, you don't have those clothes, you don't make any revenue. So we subtract out that cost of goods sold and we get a calculation called gross profit. And gross profit is simply revenues minus cost of goods sold. Okay, sales minus cost of goods sold, whatever it is that you have for revenues minus whatever that direct cost of making that revenue is. So the term we use when we have these subtotals, if you will, is a multi-step income statement. So a multi-step income statement would take revenues minus cost of goods sold equals gross profit. A single step would skip this step. It would not do a subtotal. It would just go revenues and then list all the expenses. There would be no subtotal. I think you'll find as we look at these financial statements that most companies use the multi-step. I think it's the most clear of the forms, but FASB does not say it has to be one or the other. So you do get to choose. There's no right answer unless I ask you what gross profit is, then you need to be able to calculate what that is. Okay, using that formula, revenues minus cost of goods sold or less cost of goods sold equals gross profit. Then we subtract the other expenses. This is the place where most of the time, if it's an expense, it says in the title, expense, rent expense, utilities expense, salaries expense, okay, that sort of thing. However, not always, but, and we would know that any of those items go here. So then we subtract those expenses, and there could be a whole list of them. There could be one or two, there could be 10 or 20, it doesn't matter. Income statement works the same, we just list the expenses. And there's no particular rules about what the order you list them in. I would say that most of the time companies list them the biggest to the smallest in that list of expenses in terms of dollar amounts, but there's nothing that in the rules that say that you have to list them a certain way. Then we add gains and subtract losses. So gains and losses are different than revenues and expenses. Gains increase our net income, so they're added. Losses are subtracted. Okay, now I'm going to come back and talk a little bit more about the difference between gains and losses and revenues and expenses. Let's just say for now that there should be less under gains and losses than there are under revenues and expenses. So it's more unusual than revenues and expenses. It's a good thing to remember. Then, and again, this is just kind of how it's usually done. We list tax expense, and there's some rationale why we put tax expense at the bottom of all of our expenses. So notice we've already done all the other expenses. We've already done gains and losses. Now we come back and kind of deal with tax expense. And that's not a hard, fast rule that it's last, but a lot of accountants feel like tax expense is more under the control of the government than it is of the company. So we kind of put it at the bottom. We know we have to pay it. We know it's a cost. If you don't pay it, you could end up in lots of trouble. And yet it really is dependent on what the government has said the taxes have to be. And we really don't have that much to say about what that amount is. I mean, we can do some things to take advantage of tax breaks and things like that. But at the end of the day, those laws are really determined by somebody outside of the company. So we put that last most of the time. And that is subtracted. So all the expenses are subtracted. And then your end result, the bottom number, is net income or net earnings. In accounting, the term net means something has been subtracted. So anytime you see anywhere on the financial statements or in any description in accounting where it refers to something as net, okay, that means something's subtracted. And you can remember that because you understand when you get, as an employee, you get your net pay. You earn your gross pay, but you actually receive your net pay. What's the net pay after the taxes are subtracted out? That's the term. Something was subtracted out. You know, it was the net. Okay. And it's the same thing here. In this case, all of the expenses were subtracted from the revenues to get your net income. Now, the thing to remember for this whole statement is that it must be for accounting period. That time period assumption we talked about last week. There must be a beginning and an ending. So if we're doing an income statement for 2020, then it begins the calendar year. It's not a fiscal year, but a calendar year. It starts on January 1, it ends on December 31st, 2020. If transactions and things happen after January 1 or January 1 later and December 31st should be earlier, then it belongs on the 2020 income statement. If it happens on January 1st, 2021, it does not belong on the income statement. It's not measured by the income statement for 2020. That there has to be a beginning and ending, and you really can't do accounting or do an income statement until you know what the beginning and ending dates are going to be for your accounting. Okay. So some things to remember from the income statement. And this probably statement as far as gets most attention. Even when you were going to Apple's financial statements and looking for the numbers that stood out to you, I'd say the majority of you picked numbers from the income statement. Okay. So here's what you want to, make note of. If it fits the definition, if it fits the definition that we've earned it, okay, for revenues, or it has happened and it's going to cost us expenses. The term we use is incurred expenses. They've actually been used, then it belongs on the income statement. If it doesn't fit that definition, and remember, we talked about that last week, definitions of asset, liability, revenues, and expenses. So now that becomes extremely important because now we know, if we know that it's an expense, now we know where to put it on the financial statements. And this is where it goes, because most items only have one place on the financial statements. They need to go one place. Now, back to the idea of there's a difference between revenues and expenses and gains and losses. Okay. So, first difference. When a business sells inventory, the stuff that it was set up to sell, that's a revenue. So let's use the example of Nike. When Nike sells shoes, that's what business they're in. They're in the shoe business, amongst other things. Clothing business, whatever you want to call it. But when they sell shoes or clothing or things that they purchase for the exact reason of selling it, that's a revenue. Whatever they sell it for is a revenue. Now, occasionally, and again, it's more unusual, Nike has to, change out some of its, let's say, equipment it uses to make shoes. Let's say that there's equipment that they need new equipment for because it's a new shoe line, and so they sell the old equipment. When they sell the old equipment, it's still a sale. So use the same terminology as when they sell shoes. But when we sell equipment, we're going to record it as either a gain or a loss, not as a revenue, because they're not in the business of selling that equipment. They're not in the business of selling buildings. Any of those things would be outside of their normal business, all right? And there would be either a gain or loss. And the gain or loss depends on what we sell it for compared to what we paid for it. If we sell it for more, it's a gain. If we sell it for less, it's a loss. So outside of our primary operations, and it's one amount instead of two. So when Nike sells shoes, it puts the cost of those shoes in the cost of goods sold. It puts the price that they charge the customer into revenue. So two numbers. When they sell equipment, they compare the amount they sell it for to what they paid for it. The difference is either a gain or loss, one number, only one. Okay, so that's the thing that we to remember. And it all comes down to how much we want to emphasize. Remember, this is about communicating. And when we're communicating about selling shoes for Nike, we want more detail. We want to know how much they were sold for compared to how much we paid for them. When we sell that equipment, it's not nearly as important. So we're okay with just reporting a single number instead of two. So it's just a matter of what we're communicating as to how important it is. Okay. Tax expense, we already talked about that, determined by the government, not the business. Typically, when we've looked at the income statement, you'll see 2 years, 3 years actually, in every example we've seen so far, because we want to see what happened over time. So what happened in terms of revenues and expenses in 3 years ago, 2 years ago, and this last year to show the trend. And our sales going up, our expenses going up, is our net income going up, or is it going down, or is it just staying the same? And perhaps no number gets more attention in accounting or in business in general than what net income. Right? It is key in determining the financial health of a company. So can you generate revenues, cover the costs, the expenses of making those revenues, and have some left over for the investors, the shareholders, to get a return on their money? If you can, then you can get people to invest. If you can't, chances are they're not going to be very happy to invest. They're going to go somewhere else. Questions? Comments about income statement? So while I'm not an advocate of memorizing things very often in accounting, it's pretty close to needing to be memorized to know that the income statement is revenues minus expenses equals net income. That's the simplified general equation. Now we know that there's a subtotal in there and things like that. But again, those are not absolutely, and of course, gains and losses happen to and they're more unusual. But if you can memorize the idea of revenues minus expenses, you'll be in pretty good shape in terms of the income statement. All right, as you are looking at doing an income statement, okay, review of the idea of an asset versus an expense and concept of future versus past benefit. Okay, so if you pay rent for the next year, that's an asset. As the months go by and you utilize it, it becomes an expense because the benefit moves from the future to the past. Inventory, we just talked about that. You buy the inventory, it's an asset. When it gets sold, it's an expense. Because whatever is in the future now will be the present tomorrow. So even a building always starts out as an asset when you buy it because the benefit is in the future. But what happens over time, it gets used and it moves from an asset to an expense. If when you see it, it's already been used, for instance, your utilities, we used as an example last week, then it was always an expense. It didn't start out as an asset. All right. Sometimes, like in utilities, you actually get the bill for it after you used it, and then you don't have to pay it for a while. So you actually have an expense and a liability that you're going to pay later. So it's a matter on the expense side when you're going to use it or have used it, not whether you've paid for it or not. Conservatism is an equal chance, and it has to, between two options. However, and the idea on this between asset and expense, if you've got something that is equally likely to provide you a future benefit versus past benefit, and you can't decide, you think it's literally, it could be, you could decide either way, you would err on the side using conservatism of making it an expense because that would make us look the worst. So if you had a cost, an amount that was paid, and you're not sure between the two, and you think there's an equal chance it could provide benefit into the future as it is that it's already been used up, then you would choose expense. Now, last little quirk, you might say, just a reminder, dividends are not expenses. Dividends are not expenses and will not go on the income statement, but will go on the statement of equity. So please don't put your dividends that you pay on the income statement. That is dividends that are paid by the company, not dividends received from another company, but dividends that are paid by the company we're doing accounting for. Those will not be on the income statement. They are not the cost of earning our revenue, so they do not fit the definition. All right. So next statement, and this is in order, right? We've got an income statement. We now know what our net income is. We've calculated that. We have the bottom number, the net income. We've subtracted all the expenses. Now we move on to a statement of equity or retained earnings. This measures the changes in the equity or retained earnings. So there's two pieces to equity or retained earnings. Okay, capital stock is a term the textbook uses, and retained earnings. Retained earnings is all of the net income that a company has made and not paid as dividends since the beginning of time. All right. So the statement of retained earnings tells us how our net income are how our retained earnings changed. So once again, we need a beginning of the accounting period and an ending of the accounting period. So if we were doing 2020 calendar year, the beginning here would be January 1st, 2020. That would be what your retained earnings was on January 1st, 2020, which, by the way, is exactly what it was at the end of 2019. Put a little star by that little idea. Okay, whatever you end in retained earnings from 2019 is what you start in 2020. Whatever you end in 2020 is what you start in 2021. There are only two changes to retained earnings. So when I ask you a question about changes to retained earnings, you're going to remember that it goes up with net income. And where do you know what the net income is? From the income statement. That's why we had to do the income statement first. Otherwise, we'd be stuck right here. We could not go any further because we wouldn't know what net income was. So we start with what we left over from last year, add in our net income from 2020 from the income statement, then subtract dividends. This is where dividends goes. This is where we would put it in the financial statements. Sharing of the profits with the shareholders, that's what dividends is. We subtract that, add net income, subtract dividends, equal your ending retained earnings on December 31st, 2020, which then of course becomes your beginning for 2021 when we start the whole thing again, right? And count up net income and all that sort of thing. Okay? So there's only two things that change retained earnings. It goes up with net income, down with dividends. I will say if the company has more expenses than revenue, that's called a loss on the income statement. So instead of net income, they would have net loss. That would make retained earnings go down. That's like the opposite of net income. And so it would do the opposite to retained earnings. Okay. The statement of equity also measures the changes in capital stock. And I'll tell you, for our purposes, the only thing that will change capital stock is selling more stock to shareholders. And that will make the capital stock go up. We will not do anything in this class to make capital stock go down. So the only direction it's ever going to go for us is up. So whatever you had left over from last year, the same formula. Starts with what you left over from last year, plus any new stock. There's no such thing as anything that makes it go down, so there's no subtraction, equals your ending capital stock. If you just choose to do two columns, capital stock in one column, retained earnings in a second column, then that is a statement of equity. If you just do retained earnings, it's just a statement of retained earnings. Okay. Definition of retained earnings again there on the screen. You see, it actually makes sense. Retained earnings. Everything we've ever earned and kept. That's what we mean by retained. Okay. And capital stock represents the amount originally invested in the company by shareholders or stockholders, whatever term you're choosing to use, or by owners, in fact, if you want to be really generic. It's what they put in to the company. That's the definition. So equity is retained earnings plus capital stock. Questions about this statement? We have not really looked at these in the real deal. When we've looked at Starbucks, when we looked at Nike, when we looked at Apple, we did not look at this statement very much because it tends to be much more complicated than what we just learned in real life. And so I tend to steer students away from it because it can be a little confusing. and focus just on this simplified version. Come back to this idea in intermediate accounting and fill in all the complicated stuff. Income statements, you can handle the real deal. Statement of equity, retained earnings, a little scarier. All right. So you've got an income statement, you've got a statement of equity or a statement of retained earnings. It tells you what your ending balance was in capital stock and in retained earnings on December 31st, 2020. So here we are at the third financial statement. That's a balance sheet. Okay. The balance sheet is where we find our first introduction, if you will, to the accounting equation. This becomes absolutely vital. This is the next thing you really do need to memorize. Okay. And that is assets equal liabilities plus equity. And you can use the term stockholders, shareholder, owners, whatever, to describe that equity. Or you can just call it equity for all I care. Most of the time that'll be fine as well. But you'll typically see the full name on the real balance sheets. So this equation is the fundamental part of accounting. This needs to stay in balance. That's where the term balance sheet comes from, which also can be called the statement of financial position as well, if you want to be extra sophisticated. So as a business changes, as they do things in their business, as they sell things, as they buy assets, all that stuff, assets and liabilities plus equity have to stay equal. So for instance, if you're going to add assets to a business, you basically only have so many choices on how that can happen. One, you could exchange one asset for another. So that in that case, your assets wouldn't change and your equation would still balance. The other is you could get an asset by borrowing money from someone. Therefore, your liabilities would go up and your assets would go up. You could get assets from getting it from the shareholders because they put money or assets into the business, which would mean their equity goes up and their assets go up, and you see that it still balances. So our efforts are to record and communicate to our readers what's changing in our assets, liabilities, and equity while keeping this equation in balance. That's you might say is the tricky part, is keeping it in balance. What that also introduces to us, and we'll get back to this in more detail in chapter 5, is that there's always two things happening. Because if assets are changing, so do liabilities have to change. Okay? So there's always, I like to say that it's like a second law of thermodynamics. For every action, there's equal and opposite reaction. For every change, there's an opposite equal change on the other side. So on the balance sheet, when we use the term often we use is classify. We divide our assets into current and long term, and our liabilities between current and long term. And that's based on time, that old time period assumption. Current assets are going to be used in the next year. That's what we mean by current. So we put them at the top because those are going to get used first. Long term or down further because they're going to take more than 1 year to use. Okay, for instance, if you have a receivable, remember the term receivable means asset. If you anticipate receiving it in a year or less, it should be a current asset. If you anticipate receiving it past 1 year, 2 years from now, 5 years from now, then it would be listed under long term. On the liability side, that's based on due date. If something you owe is due with less than 1 year, that would be a current liability. If it's due past 1 year, it's a long-term liability. Okay, so I want you to get kind of comfortable with that definition and that cutoff so that we understand real financial statements we may be looking at, that sort of thing, as well as when we build a balance sheet, we get used to the idea of putting current assets and current liabilities kind of at the top, okay, and then the long-term further down. Okay, so review that on the balance sheet, we're going to show capital stock and retained earnings. That's the equity part. So right now, there will only be 2 sections under equity. Under assets or liabilities, you could have a whole list of things. You could have, depending on how they borrow, how they got their money or what assets they have, we could have 5, 10, 15, 20 assets, different kinds of assets. We could have a whole bunch of different kinds of liabilities. But under equity, we have capital stock or some form of stock and retained earnings. That's it for now. So another way to look at this formula is to rearrange it a little bit. Think about the term net, right? Net assets means something is subtracted. So if we took assets and we subtracted liabilities, that would equal net assets, which is also equal to equity. So net assets and equity are synonymous, are the same thing. And by the way, for those of you, if you've had any interaction with a nonprofit, they do not use the term equity. They use the term net assets. But it can apply to any company, profit or nonprofit, because it really is the same. But most of the time, we use the term when it's for-profit business, we use the term equity, not-for-profit net assets. So to change net assets, you must either change capital stock, money to or from shareholders, or retained earnings, meaning you have to have net income or dividends. And net income, of course, we remember is revenues and expenses. So anything to do with revenues and expenses is going to affect retained earnings. And if you affect retained earnings or change your retained earnings, you're changing net assets. Okay, and that's what that last statement says. Gains and losses could be thrown in there too. Gains and losses affect our net income, therefore they would affect our net assets or equity. Notice though, there's a limited things that affect net assets or equity. It has to be revenues, expenses, dividends, or buying of stock by shareholders. Okay. If it doesn't fit in that, then it's not going to be part of or change net asset. Let's see. So all changes must keep the equation in balance. Changes to the asset side must be balanced by changes to the liability equity side. Now, this is important. We had 2 statements, income statement, statement of equity, that has a beginning and an ending date. A balance sheet does not have a beginning or an ending date. It has a single day. It is not measuring what happened during a year. It measures where we are at the end of the year, a single point in time. We pick the day, December 31st, for instance, and we look at what the assets, liabilities, and equity were on that particular day. So when you look at a balance sheet, you're expecting to see one particular day being mentioned as the date of the balance sheet. When you look at an income statement, you're going to see you want to see a beginning and an end. Okay, so that's a big difference between the financial statements. Balance sheet is for a single day. Now, typically your balance sheet is for the end of whatever the counting time period was for the income statement. That's what makes sense. Okay, so just go back here. Where are you going to find your capital stock and retained earnings, the amount to put on your balance sheet? Well, you're going to get that from the statement of equity, this ending retained earnings. Is going to be the retained earnings that you put on this balance sheet as part of the equity. Okay. And same thing with capital stock. All right. I want to do let's stop sharing for a bit. Let's pause for a minute and do a poll to see how we do with net assets or equity concept and what affects it. Okay. So this is a question where you can choose as many answers as you think are right. Okay. So there's more than one that is correct. So go ahead and choose what you want. Don't choose all of them. That would be a little crazy. But find those that you think are going to do that based on this poll. And we'll get everybody's vote and then we'll talk about it. Need a couple more votes. There we go. Everybody has voted. I'm going to share the results. So we chose the largest percentage was purchase of inventory for cash. All right, now let's think about that for a minute. I exchange cash for inventory. So who can tell me what cash is on what element from last week? What is cash? Asset, liability, revenue, expense.
Asset.
Did I get anybody to chime in with that answer?
It is an asset. So he did say it too.
So anybody tell me what inventory is then?
That's an asset.
All right. So inventory and cash are both assets. I'm not hearing your answers. If you, Zoe, thanks for telling me, but I'm not sure why I'm not hearing answers from you folks. So maybe we'll have to go with the chat or something like that. But both are assets. So what's happened is you exchanged one asset for another. You've given cash and received inventory. When that happens, assets don't change, and therefore net assets don't change. Because if assets minus liabilities equals net assets, if you don't change assets, you don't change liabilities, okay? You don't change equity at all, then it is still the same. So purchase of inventory for cash did not change net assets. So unfortunately, more of us missed that than we should have, okay? But now we'll remember that and learn from that and say, okay, when I buy inventory for cash, I've exchanged one asset for another, and therefore no change in net assets. That is the same thing for the purchase of inventory on credit. This time, you're going to buy on credit, you're going to have a liability. You buy inventory, assets changed, but so did liabilities. So if assets went up $50 and liabilities went up $50, then assets minus liabilities is going to be the same as it was after that, but compared to what it was before. And then borrowing money from the bank, same thing. Change of asset and change of liabilities. So none of the first three affect net assets or equity. The last two, which we had pretty good numbers for, both involve, the first one, revenue. And remember, if we're going to affect equity, we're going to affect net assets, we have to do either money from the shareholders or revenues and expenses or dividends. Okay, so here we have providing services to customers for cash. That's a revenue. We did the services, we earned it. They gave us money for that, and therefore it is revenue, and it makes our net assets go up. Renting equipment would be an expense, because why are we renting it? To provide services right now. Okay, so that would be an expense, and therefore would make our net assets go down. So those two were the right answers. The first three were not. All right. Now let's try a second polling question and see if we get a little better on this one. Okay. Same idea. Can choose more than one answer. More than one is correct answer. Okay, one more vote, please. All right. So this case, we have paying cash dividends coming out as, oh, wait a minute, gotta share the results. There we go. Cash dividends, number one answer, and that is correct. Okay, that's specifically reduces retained earnings, which is part of net assets or equity. That is a correct answer. So that would make it go down. Selling inventory to customers is a revenue. It also involves an expense. So it changes net assets or equity as well. So first two are correct answers. Paying off a loan is not. When you pay a loan off, okay, you affect assets, cash that you pay, and the liability that you're paying off, but nothing to do with revenues, expenses, dividends, or capital stock. The more tricky one was collecting money from a customer who bought inventory last year. When they bought it last year, that would have affected net assets because we would have recorded it, would have been the same as number two. But when you actually get the money, all you're going to do is exchange your accounts receivable that you had when you sold it to them for cash. So it's exchange of one asset for another, which does not change net assets. So collecting money would not change equity or net assets. Okay, so if you have questions about those or concerns, if you want to put it in the chat, that'd be great, since I'm not, for some reason, hearing you very well. Okay, why does paying off a loan not affect assets since I'm spending money to pay it? Well, it does affect assets, okay? Let me give you an example. Let's say that you have assets of $100 and you have liabilities of $100. So you have currently zero net assets, right? Net assets is assets minus liabilities. And in this case, we're going to pretend for just a minute it's exactly zero. All right. So if I take $10 of my assets and I pay off $10 of my liabilities, I now have $90 of assets and $90 of liabilities. 90 minus 90 is still zero. So do you see how it affected assets, affected liabilities, but it didn't affect net assets or equity? All right. So that's why it's a little tricky about this. That's why we're practicing. All right. So feel free to think through those scenarios, and it'll help you, especially as we get into chapter 5, when we deal with a whole bunch of those types of changes to our various assets and liabilities and so forth. All right. So I want to go back to our PowerPoint. And move on to our final financial statement. And the one that we will probably be the least expert at the end of this class, because let's be real honest, we just run out of time and to talk about it to some extent. So we're going to give you the basics here, and then it'll be in a later accounting class where you'll actually get into the more of the detail about how it's set, how to build it. So when we're going to do the other financial statements a little bit more, okay, just so you know. All right, so statement of cash flows is literally a description of how much and how cash changes. So we look at it's another one of the statements that has a beginning and an ending. We have what was our cash, and I want you to imagine looking at what was in your bank account on January 1st of 2020, and then looking at it on December 31st, 2020. That's what we're doing. We're looking at how much cash the company had starting at the beginning of the year, at the end of the year. Why cash so much? Because cash is essential to operate your business. Cash has two characteristics you should remember. You have to have it in order to pay your bills and your employees and that sort of thing. But it's very inefficient. It's not a very good asset for earning more money, okay? So it needs to be invested into other things. That's what we usually do with our cash, is buy stuff that's more useful, like equipment and stuff like that. But we need to know some details about what we did with our cash for the year. So if you think about your bank account, if you had $5 at the beginning of the year and $10 at the end of the year, then your change in cash was $5. And that's important, you might say. It went up $5, but it really doesn't tell us much about what happened all the way through the year. So the cash flow statement is kind of telling us the story of how we went from 5 to 10. And to do that, it takes everything, every event in the business that changes cash for the year and puts it into 3 buckets. One of 3 buckets. Every one of those changes in cash has to go into one of these 3 buckets. It's either an operating activity, an investing activity, or a finance activity. Okay? So everything that changes cash has to go in one of those 3 buckets. And the cash flow statement simply says we started with $5. We add in all of the things that went in the operating bucket. We added or subtracted the amount that was in the investing bucket, added or subtracted the amount in the financing bucket, and we ended up with $10. Okay? So I'm going to explain the 3 buckets based on things that hopefully you can relate to in your life. So in your realm, your operating is the main business activities. So Nike, it's selling shoes, paying employees, advertising, all those things. Most of their activities go in operating. For you and I, our main operating activity, cash flow wise, is working for someone else, probably. We got a job, we get paid, okay? And that is our operating cash inflow from our salary or wages or whatever. If we have to pay for gas to get to work, we have to pay for food to stay alive so we can go to work, those would be operating cash outflows. That would mean money going out in order to do our main activity, which is go to work. Okay? Now, I'm not saying the whole reason you live is for going to work, but as far as cash is concerned, it's typically our main focus, okay? And that would be our operating activities. Anything to do with that job. Now, investing is when we have a situation where we have cash that we need to invest into other assets. So for instance, let's say that over time, you realize that the amount coming in from your job is more than you need to pay for food and utilities and gas and that sort of thing. So you take some of that cash and you buy a big screen TV. or you buy a computer, or you buy a better car. Any of those things would be investing, would be buying those long-term assets, all right, with that cash. And the cash would go out the door. It would be negative, okay? So it would subtract from your bank account when you bought those assets. Now, if things were not going so well at work, okay, and your cash flow was getting hurt or something, then you might decide that you need to sell some of those assets you thought you couldn't live without, like your big screen TV or your car or something like that, and get something smaller or whatever. And when you sell that and bring in cash and it goes in your bank account, that would be a positive cash, but it would still be investing. So if it's buying the big screen TV, selling the big screen TV, buying a car, selling a car, if you're an actual company, you're buying buildings, buying equipment, all that kind of thing, or selling it, it would all be investing. Those all go in the investing bucket. Financing, let's say that things aren't going as well as you would like as far as the cash flow from operations. And so you need extra money. And so you look to a family member, or you look to the bank, or you look to some other way to borrow money. That would be cash coming in. They would give you cash. That would be a positive cash flow in the financing. That would go in the financing bucket. Now, obviously, you personally can't have shareholders in yourself, although some people have tried that, okay, sell stock in themselves. But that would be cash coming in. If you could sell stock in yourself, that would be cash in the financing section or bucket. When you pay off that loan, you give it back when things pick up at work and you're able to earn enough to pay off those loans, that would be cash going out. That would be negative cash coming out of your bank account to pay for those loans. Okay. And that would be a financing in the financing bucket as a negative. Okay. So when we have cash going out, that's a negative, and we tend to use, instead of a little minus sign in accounting for negative, we tend to use parentheses. It's a lot easier to see than a little minus sign. And so when you see that on financial statements, that usually means it's a negative number, okay, or it's being subtracted. All right, and cash coming in is going to be positive. All right. So those are the three buckets. If you take all of the things that affect cash and you put them in those three buckets and then kind of add up each bucket to see how much it is, then add the three buckets together, you should get the change in cash. That's how the statement of cash flows works. So this is kind of the flow of this process. Remember, you'd have a balance sheet left over from last year. Then you'd start the new year. So this would be, you'd have this left over from 2019. Then you start January 1, 2020. And you measure revenues and expenses for the whole year, all the way until December 31st. And then you stop, right? You cut it off. Time period's over. You figure out what your net income is. Now that you know what all the revenues, all the expenses are. Okay? Then you create a statement of equity or retained earnings. Where do you know your retained earnings from the beginning? It's back from this balance sheet left over from last year. You're going to add the net income you just got from your income statement. You're going to subtract out your dividends, and you're going to end up with retained earnings. If you're doing this changes in capital stock, you would make another column for that and do the same thing. From those numbers, you now have the balance sheet at the end of the accounting period. Okay. And of course, that's where you list your current assets, your long-term assets, which equal your current plus your long-term liabilities, plus your capital stock, which you got from the statement of equity, or your retained earnings from your statement of retained earnings. And always last but not least, you would do your statement of cash flows after you know all the other pieces. Then you would go back and look at the changes in cash, put them in the 3 buckets. All right, because then you know you've got all those changes. You really need to have your balance sheet done at the end of the year to be able to identify all the changes. So until you have that and figured out and put on paper or in the computer, you really can't do your statement of cash flows. So that is how the financial statements all look together. So what questions do you have about those financial statements? All right, no questions coming up. No, nothing in the chat. So here's what I want us to be aware of. The homework for this week is longer than we have experienced in chapter 1 and 2. Chapter 3 homework, I have assigned you 8 problems. There's no research one like we've done in the past. All right. So there are 8 problems 1 through 8 that you need to complete, which is a little more work than we've had to do in the past 2 weeks. So, and of course it's due by class time on Thursday where we'll go over it in detail as we did the last 2 weeks to make sure we understand it. So I want you to get kind of a start on this as soon as possible. All right, so we're a little early on class today in terms of the time period, because this is something that you kind of need to practice to get the hang of it. So just so you have you're prepared for these problems. The first problem, you're going to identify based on the description where it goes on the financial statements, which financial statement you should use it for. Okay. And there's only 3 choices. You can't use cash flows. It only asks for 3 choices: income statement, statement of retained earnings, or balance sheet. Okay. There is a couple of them that go in more than one place, but only a couple. So don't get carried away on that. Okay. So based on what you're looking at, you'll determine what financial statement. Then there's going to be an income statement you're going to need to prepare. It's going to give you the what they are and the amounts, and you'll need to put it in an income statement so you can calculate the answer. Then there's a balance sheet question. Okay. Then there's a question or a problem about determining whether it's an asset or an expense. All right. Then there's a little problem having to do with figuring out the missing balance. I'll tell you, give you Zoe asked, wondering about how to prepare for our midterm, and are they going to be similar to your homework? Very similar, okay, to your homework and to some of the things we've done looking at the financial statements in class. Okay. All right. So number 5 is what you're going to have to do is remember the equation from each of the financial statements and fill in the missing numbers. Okay. fill in the missing numbers based on what it would have to be to make it work. So for instance, if you know assets and you know liabilities, you should be able to calculate what equity is, right? Because it has to equal. If you know revenues and you know expenses, then you can figure out what net income is. If you know revenues and you know net income, you can figure out what expenses should be. Okay. If you know assets and equity, you can figure out what liabilities are. That sort of thing. Okay. And then there's another income statement, balance sheet, and finally, number 8 is cash flows. So there's a chance to work through 2 income statements, two balance sheets. All the amounts are given to you. You just need to put them in the right place. All the accounts based on it and so forth. All right. So you want to get started on that. In fact, I'm going to let you go now to work on that. I'm going to go into the other Zoom room, the one we use for my office hours, in case you run into any problems. So I would encourage you to go right at these problems right while it's fresh in your mind about how these work, and when you can ask a question right away. All right, so I'll be monitoring the discussion board and the other Zoom room to see if you have run into any trouble. All right, so we're looking at the problems at the end of chapter exercises in chapter 3. Any questions? All right, then go give it your best shot, and we'll be ready to answer any questions for you so that you'll be ready to go over them on Thursday.